Now we're going to reach the point where we're going to use the T accounts to record financial statements. But not all of those accounts are corrected or adjusted by the end of the year. A perfect example of the need to collect the accounts is going to be what we looked at with the unearned revenue. So for example, if you had a collection in advance of $300 at the end of May, and you have to prepare financial statements for the quarter ended June 30th, you may have to make an adjustment that's going to reduce the unearned revenue and recognize the revenue earned. So the fact of the matter is that you might be looking at something like this. Just to give you an example of a need for an adjustment. The liability. And that was 300. And that's on May, let's say 31st. Now you're going to prepare financial statements. And you want to prepare financial statements as of June 30th. The problem is that all of your accounts may not be up to date. So when you look at your list of accounts, your trial balances of accounts, that liability may not be up to date. So what we need to do is go through all of the accounts and try to find those that are in need of adjustment. And in this case, we'd have to make an adjusting entry. Let me put that over here. So on June 30th, I have to make an adjusting entry. And that adjusting entry is going to do what? It's going to recognize that I earned 100 in revenue, just take the month of June, and I also need to get my liability down to 200. Now, in a couple of weeks, you're going to be able to play around with T accounts and see the answer immediately. So I know, for example, I may not know the adjustment amount, but I know the balance that has to be there. There's two ways to approach this. You could say, I've earned 100, or I still owe 200. Same way to look at the same event. I owe 200 more to my customers, but I've earned 100. Either way. So I could approach it by saying, well, I know the balance has to be 2, so I know, I don't really, again, like we talked about some of the homework, you got to kind of spin numbers around and sneak through and get the answer. Sometimes if you don't have enough information, I could tell you, all right, the balance got to be 200. I guess I got to debit that account for 100, and that's basically what happens. But the direct approach would be to say, well, in my adjusting entry, I'm going to need to debit the unearned revenue which reduces the liability from 100, and I'm going to credit revenue earned. And that is going to be revenue and stockholders' equity. And when I post that account, it's going to be on June 30th. I'm going to have a credit balance for my adjustment. And I wind up with a liability of 2, which I knew I should have had, and the revenue earned of 100. So the transaction analysis here helps us to get to this point. So when I prepare the balance sheet and the income statement as of June 30th, I'm going to have revenues of 100 and I'll have a liability of 2. So not all the accounts are correct, not all the accounts are fully adjusted, and that's one of the things we have to do. We have to look at all the data and determine whether or not, like the prepaid expenses, the same thing, may not be fully adjusted at the end of the accounting period. All right, so that's part of the accounting cycle. When we look at the general ledger, the next part of the cycle is going to be to have a trial balance and then make the adjustments. So that's going to be the next part of the cycle. So we go through this chapter. If I can find it. There we go. We're going to look at the cycle, and we know that we analyzed and we recorded, and when we recorded, we journalized and posted the accounts. Then the next step, which is this chapter, is we have to adjust them, then we report them, and then we close the books. So in this recording process, it's the journal and the ledger, right? That's how we record. We'll also have some trial balances put in there as well, but we will have to adjust the accounts. So I'm going to go over some transactions right now, which are repetitive. But again, just to be sure before we leave for this week, and of course I adjust the homework. I was telling somebody outside that, you know, I don't mind being a little bit behind. I want to go as slow as I can. I'll adjust the homework, so don't worry about that. But in this case, we will get to these adjustments. And the reason why I opened up the chapter with this example is because it ties back to where we were. Plus, it really gives you the main, the main thrust of this chapter. It's to go to the adjustments, get the statement accounts, or get the accounts ready to be reported in financial statement format, and then we're going to close the books. All right, so let's go through. And again, as I said, a lot of these are not done all the time. I mean, obviously, I think the journalizing and posting is continuous. These adjustments are made at the end of the period. Whether you mentioned a 2-week cycle, whatever it might be, whatever the cycle is, if it's monthly, quarterly, annually, that's when you make those adjustments. All right, so let's go through. We're going to go through some transactions in a minute. But first, I just wanted to make sure in any information system, you know that there are various accounts. These accounts are going to be used for reference purposes. This is known as a chart of accounts. Chart of accounts has no numbers. You don't record anything in here. It's just your reference point. So if you've been working, someone says, well, what account number should I charge? Right, you've heard that. So these are the account numbers that we have: assets, liabilities, equity, revenues, and expenses. Typically, these are the accounts. It's like 5 categories. Usually, could be more. The asset accounts usually start with 1. It's either 100 or 1,000. Liabilities are 2, equity 3, and so on. We usually leave like lots of space in between. So, for example, if you look at the cash account, it's 110. Receivables go up to 120. So if you were designing an information system, you would want to have enough space in case there's another cash account. What if there's restricted cash? Sometimes you got escrow accounts. So you may have to build different accounts. So you leave space in there. And again, this all relates to an information system type approach. I mean, I know we use paper and pencil or computer kind of things that are paper and pencil light, but even here, I mean, you got different furniture and fixtures. You might now get a building. You may add that account to 180. So you may have to add accounts as we move along as well. So it's really just a listing of the accounts that we're going to be using. And you would, in fact, have a cross-referencing system somewhere. So, for example, this would be account in this system. This would be account 250, and revenue earned or sales revenue would be 410. And if I was doing this in a computer system, I would probably just have to plug in the numbers. So right now, if I'm doing, I haven't worked with QuickBooks or any of those kinds of things, but I'm sure if you did, the unearned revenue gets debited and you would have to look up the account, so it's 250. So probably in here, you have a reference of 250, and in the revenues earned, it's 410. And that's the way you would enter it. You wouldn't be making journal entries, you would be putting the account numbers in. So you debit, you instruct the computer to debit account 250 for $100, and you would instruct the computer to credit account number 410 for the revenues for $100. So that's the way it would work. Now again, this is not a place to record anything. It lists all the accounts in the ledger. So we know that, just reviewing again, that the book of original entry is the journal, and that's where we journalize transactions. And of course, the general ledger is the book of final entry, and that's where we're going to post those accounts into one of these categories. And there are subcategories, as we know, within each. Now, I'm going to go through a couple of transactions, and we'll pick this up on Thursday, but I'm just going to review the recording process. This is going to be the last time we're kind of like seeing this in a methodical approach. So what I want to do is go to June. We're moving to the next month. Oh, I'm sorry, yes, yeah, we know that. Just said that. Here we go. All right, so now we're in June. And in the month of June, we're going to assume that our sample company, Jana Juice, signs a 2-year note to borrow $12,000, and they agreed to pay 12 months interest on the first day of each month with the principal due at the end of 2 years. Now, this is where I'm going to take these transactions, record them now, just as we did earlier this morning, but when we get back on Thursday, we're going to have to see whether or not any interest accrues on this transaction. So again, let's go through this, and stop me at this point because, for the next 15 minutes or so until Ben gets here, I want to make sure that you're very comfortable with this process. So if we were still using the equation, we would increase the asset cash by 12, and we would increase the liabilities by 12. The equation balances, notes payable goes up by 12, cash goes up by 12. This is, if we were looking at the source of cash, this would be categorized as a financing cash flow. This is a financing cash flow. Now, the journal entry, of course, this is the way you analyze. The next step is to record. The recording starts with the journal entry. Debit the asset cash, credit the liability notes payable. Again, the format, debits first against the margin, credits are indented. And here's an explanation, something we're adding in this chapter. Explanations are generally not required, so if I give you an exam, I'm not going to ask you to write the explanations. I would say that in most cases, this is not done. It could be done. Well, it may have to be if you're filling out like an order to an entry. Someone's got to fill out an entry or sign an approval to borrow the money. We'd have to explain what it's for. But in a very informal system, if I look at that, I know what it is, right? And pretty much I don't have to explain it. Okay, so then the next step would be to post that. And of course, we debit the cash account, T account in the ledger, and we credit the notes payable account in the ledger. So again, journalize, analyze, journalize, post. That's what this book keeps telling me. So analyze it first, journalize, and then post it. All right, so let me go on to the next. You can stop me if there's anything you would need to be repeated. Okay, now something different. They purchased equipment. Now this is going to be a little different because even though it looks the same like inventory, this is a different type of asset. So analyze first. We now convert a non-productive asset cash into a very productive asset, piece of equipment. We debit we will debit or increase, let me say it first, this way we'll increase the non-cash asset furniture and fixtures. We will then credit the asset cash. This is what type of cash flow? Operating, investing, or financing? investing. Long-term, operating is more short-term. So inventory, that's why I asked the question, because we were used to inventory. Inventory is a short-term asset used in operations, right? I think I was explaining that where if you look at the way a company grows, long-term growth, you need to invest in plant and equipment. Year-to-year growth, cycles. We go from cash, inventory, back to cash. Those kind of cycles are every cycle, every year, every operating cycle, that uses current assets. So this would be investing cash flow. So once again, we now convert that into a debit in the general journal to furniture and fixtures, 10,002, and a credit to the asset cash. And again, the explanation, it was obvious after a while, but again, it does convert the non-productive asset, cash, into a productive asset, furniture, fixtures, plant assets. Now remember, this does not change the total assets of the company, it just changes the composition of what we're holding as assets. Doesn't change your wealth, doesn't change your equity, not a revenue, not an expense. So again, it's just like converting cash to a car for personal use, right? Cash to a laptop computer. It just takes one of your assets and converts it to a productive asset. Posting that to the ledger, pretty simple. Debit the asset, plant, or furnitures and equipment, and credit the asset cash. Questions? Again, stop me if we're just reviewing for June. Again, a lot of these questions will come back to us. By the way, what's going to happen to that equipment account? Where's the expense related to that equipment account? So I'm using it every day to generate revenue. Here's an example of revenues that are not going to be synced with expense recognition. So I'm using this to produce every day. I'm selling goods. Where's the expense?
Depreciation.
It's going to be depreciation. So when do I depreciate it? At the end of the accounting period. So I could be selling the entire quarter using this to produce. I'm not depreciating it yet, but I will eventually depreciate this asset. And we'll talk about expense recognition a little bit more. Expense recognition could be immediate, it could be matched, or it could be over time, like this one. All right, and advertising. This one is immediate. So again, we analyze first, have a reduction of the asset cash. We increase expenses, which reduce, obviously, income and retained earnings. Now, here's a question for you. Well, first, we know that is a operating cash flow. We need advertising to operate. Here's the question, though. Could that ever be an asset? Could you prepay advertising?
Sure.
Yeah, you could. There's an argument, though, about that. For example, you got the Super Bowl commercials. Now, someone could say that the Super Bowl commercial, these most memorable commercials that they have, you paid for those on February, whatever the date of the Super Bowl was, February 4th. You know what? They're going to be selling like Budweiser for 3 years more. Their sales are going to go up because of that ad. Would you consider that ad prepaid? I mean, I can make that argument that the problem with that is we can't measure, marketing, right? We can't measure the effect. Most ads might have a slope where it hits right away and then it declines. It has more of effect early on than later. So we can't. Now, it doesn't mean that the ad does not have value. It just means we can't measure the effects. So we expense it immediately. So all those Super Bowl ads go right down the expense line and reduce income.
Maybe I'm misunderstanding the question. Let's say I prepaid in January for an ad that's not going to air.
Then you could,
so much.
right,
Okay.
then you could. If it's prepaid,
That's
yeah.
correct.
If it's prepaid, that's right. But I'm thinking, of course, Budweiser or whoever is running these ads, they're going to pay them up,
Soon as they air.
right after they air. They're probably going to make sure they air first, or maybe, in the same quarter anyway. The only time that you could call an advertisement an asset if it's a direct response ad, meaning that the coupons that go out, anything that's going to be, let's say, for the next 4 months, you could bring this with you and get $40 off. Well, it may last for 4 months, and you may have it on your books as a prepaid ad. But for the most part, because of the uncertainty, and the reason why I brought this up is because what may sound very logical to you, in other words, the Super Bowl ads are going to be, driving revenues for months and maybe years later. You're absolutely right, and it's probably a huge investing asset for the company. We don't reflect it as an asset because of the uncertainty of measurement. If we can't measure it with a certain degree of confidence, we expense it. And that'll happen quite a bit. And it doesn't mean, by the way, that it has a negative effect on the market. I'm sure Budweiser's shareholders are happy to see advertising revenues increasing. Well, advertising expenses increasing, rather, because it'll bring in more revenue. All right, so in this case, again, pretty simple. We debit advertising expense, once again reminding you that when expenses go up, they reduce stockholders' equity, and then we credit cash. Now, I guess it's important to say here it's for the month of June. You probably pay advertising, every month in this case. And of course, we now post those to the ledger, and we debit the advertising expense, and we credit cash. All right, supplies or suppliers for inventory, we're now going to pay off the liability. So once again, we're going to reduce the asset cash and reduce accounts payable. The accounts payable, as I said, I had them on board before, I erased it, that accounts payable will be normally tied to inventory. And of course, that is an operating cash flow. So once again, the difference, inventory related expenses or outflows are operating, plant assets would be invested. Then of course the journal, after it's analyzed, debit accounts payable, credit cash, reduce the liability by a debit, reduce the asset cash by a credit, and then the posting to the ledger account. In this case, we have the operating cash flow. Now, when we buy the inventory, I'm going to show you in a second, you don't have any cash flow at that point. Any questions on this one? Again, just stop me as we go through. I'm just treating this as kind of a review. All right. Now we purchase inventory on account, we increase the asset inventory, and we increase the accounts payable. The journal entry, debit inventory, asset account, credit accounts payable. And then of course, when we post them, inventory goes up by debit and the liability increases by a credit. And you notice there's no cash flow because of the increase in accounts payable. Accounts payable is pretty much used, and I hate to use the word financed, because it's really an operating action here, an operating liability, but it is in fact using or helping you in the operating cycle to acquire inventory. Okay, next, sale. Now, they sell for $3,100, cost $600. So first, let's analyze the sale. We increase the asset cash, and we're going to increase revenues, but as we know, revenues increase net income, which increases the retained earnings. To record this, this is going to be a debit to cash, credit to sales revenue. This is a operating cash flow. So we debit the asset cash for $3,100, and we credit revenues, which increase the stockholders' equity. And then, of course, posting that, as you can see, is debit to cash, credit to the revenue account. Now, again, we're calling this 6A because anytime you have a sale, you should always keep in mind that there's going to be a cost of sales. Question on the sale of products. If I did not have, if I was selling, let's say, a service, that would be it. You wouldn't have the next entry. The next entry is to record the cost of goods sold. And there's, by the way, I should have cried. I didn't see this before. It's really sale of inventory is actually 6A, not 5. So there's a typo in there from the publisher. That should be 6A. So the journal entry, we use up inventory, so we reduce the inventory. We now have a cost of goods sold, which is the related expense that is charged for the use of inventory. That expense reduces income, which again links back to reducing retained earnings. That is a debit to the cost of goods sold in the general journal and a credit to the inventory account. And then when we post those to the ledger, again, we do the same thing. Now again, the cost of goods sold has no cash flow effect whatsoever because it's using up inventory. That inventory was paid for earlier or may not have been paid for yet. So again, it's an expense not necessarily involving cash. Now, selling products on account, sales revenue goes up, and so does accounts receivable. We know that there's no cash flow here as well. It is part of operations, but there's no cash flow, increasing income and retained earnings. Journal entry you'd have to make is a debit to accounts receivable and a credit to sales revenue. And you should kind of practice these things. You know, I don't know if you want to always look at the equation. That generally becomes unnecessary after a certain point, but I would always try to think about the journal entries in the general journal and then posting to the general ledger. And again, in this case, no cash flow in the sale because the receivable went up. When receivables go up, we know that there is a reduction in cash flow. I know, Fred, you asked a question before about thinking about, well, you know, looking at receivables, could I gauge cash flow? And typically, if you look from one year to the next, if receivables are going up, it means that even though you've got sales, you're not collecting all of it. So as your receivables go up, you've got less cash flow. And if your payables go up, you have more cash flow, if you think about it, right? Because now you got inventory coming in or expenses being incurred, but if your liabilities are going up, you're saving cash. Doesn't mean you're changing net income, but you're just changing your cash flow.
So you're just affecting the balance sheet.
Yeah, that's why when we looked at the lineup of I have it right here, when we looked at the lineup of income statement of stockholders' equity, balance sheet, and then cash flow, that's why we do the cash flow statement last. This way I can look at balance sheet changes.
Okay.
And with those balance sheet changes, now I think you could see it visually that with the receivables going up, I've got less cash. I've got sales, but I have less cash. And then, of course, the cost of goods sold for the prior transaction, we just did one like this where, again, there's no cash flow. We record the expenses and we reduce the inventory. And once again, with inventory going down, reduction of inventory, that's how we incur the expense. That's an asset that's being used up, an asset that's being utilized, and that's the expense. Okay. And of course, the posting is there. All right, just a couple of others, and I'll point out if there's anything critical. We've got our unearned revenues again, the 3-month membership. Cash comes in, that's an operating cash flow. We have the liability, the unearned revenue. And again, it's going to really come back to this issue of having a balance. It's a different number this month, but having a different balance here doesn't change the fact that at the end of the reporting period, some of that may be earned. You know, in September or at the end of July, at the end of June, or sorry, at the end of July, you're going to have 1 month of that being earned. In this case, it would be $200. And of course, you debit cash and the liability, and posting that to the T account. Now, there's cash flow in this case without any revenue. And one of the things you're going to notice is that increasing any liability is going to help your cash flow in a lot of ways. I mean, when we get to the cash flow statement, if you kind of in the 11th hour and you can't figure something out, just remember if the liability goes up, it increases cash. And it's really a pretty simple rule. But in this case, it's clear that this liability is going up. It is an unearned revenue or an advance collection that is going to be increasing cash, and it increases that liability. All right, and finally, a couple of others. We got wages, and cash collected, and dividends. All right, so wage expense, again, expenses, reduce income, and earn capital, retained earnings. And we have a cash outflow. That would be an operating cash flow. Here's the way you record any expense. We'll look at, any expense in cash, debit the expense, credit the cash. And of course, posting that as well. Anything on that? All right, let's see the next one. So I want to point something out there. Cash collected from customers. We have cash flow coming in of 2,000. It's an operating cash flow. Collecting the receivable, receivables go down. Another perfect example of cash flow. If an asset goes down, especially receivables, you know you got cash flow. Right? If your receivables are going down, you're collecting. So cash coming in, operating cash flow, debit cash, credit accounts receivable. And posting that to the accounts. Okay. Now, again, the timing of this, I mean, you could have generated this receivable in the month of May. So the revenue could have been recorded last month. But you collect it this month, so you've got cash flow in one month and earnings in another. It happens. All right, and again, the expense, the last one is the rent expense for June before we get to the dividends. And again, it's a cash outflow. Bottom line here is every expense works the same way. If it's in cash, cash outflow, hit the expense, then you've got your income, and then of course your reduction of income and your effect on capital. Journal entries are always the same. You debit the specific expense, and as I said, you have to label this properly. Rent expense, and you have to credit cash. I wouldn't be that upset if you put rent cost or cost of rent or something like that, but it's got to be an expense. Right? It's better to use the exact term, and then of course you credit cash. If you, as I said, people have done this. They've debited stockholders' equity here, or debited earned capital, or debited retained earnings. I can't really give you credit for that, so you've got to identify the specific account. And then, of course, when you post that, you have a debit to the rent expense and a credit to cash. And that, again, would be an operating outflow. Now, the last transaction, and we'll summarize, and hopefully we'll get Ben in here for your election instructions. So you've got $100 paid in cash dividends. Now, dividends are not expenses, so it's a cash outflow, and as I said before, this is a financing outflow. You're going to reduce the asset cash, reduce retained earnings directly. Not every book. I mean, we're going to move to the intermediate book. It might tell you to debit an account called dividends declared. That's the preference of the authors, but it's going to eventually come out of retained earnings. Now, again, it is not an expense, but we debit retained earnings directly in this book, and we credit the asset cash. It is a financing outflow cash. And then when we post that, we debit the retained earnings directly and credit cash. And by the way, we'll know that retained earnings normally has a credit balance. It's increased by credits, decreased by debits. By debiting that account, we reduce it. The asset cash, assets increased by debits, reduced by credits, and that's why we credit that account. Okay. And finally, we've got our unadjusted balances. So these are the balances that we would have picked up unadjusted. The balance, by the way, of 6460 came from May. So if you look at cash, the opening balance of cash is 6460. And a couple of things to notice. Not only is the retained earnings account not correct, because if you remember from the month of May, and that's why I wanted to make sure I got at least to this point, so we didn't have to try to remember what we did last week, or next week rather. So the beginning, when we started our business, the beginning balance was 0. Then we had net income of 1,060. And then we had, this was in May. And then we had May dividends of 400. And the balance that got carried from May into June was 660. Perfect time. Balance that got carried from May into June was 660. Now, so far in June, we paid dividends of 100, and right now we have 560. That balance does not reflect the income for the period. So let me leave you with this before Ben takes center stage. We've got two things to worry about. Number one, we have to look at our revenues and our expenses. Are they correct? And the answer is no, they're not adjusted. First of all, we've got unearned revenue that has to be reflected in revenues earned. Secondly, we bought equipment that we used for 1 month. That has not been depreciated. So that expense is missing. And also, you borrowed money at 12% interest, and that's got to be reflected. So the revenues and expenses are not correct at this point. They have to be adjusted. Once they're adjusted, we can prepare financial statements, and then eventually the missing piece here is that we have to add in here net income for June. Adjusted. So that's going to have to be added into that account. Okay, so, and all of those revenues and expenses have to go to 0. Why? Next period, we start accumulating them again. So all revenues and expenses will have to be 0 at the end of the month of June. All right, so we'll stop here.